I want to share something with you that most people won't tell you because it makes them uncomfortable. We're standing at the edge of one of the most significant economic transitions in modern history, and the vast majority of people have absolutely no idea it's happening right underneath their feet. This isn't about fear or panic. This is about understanding patterns that repeat themselves across decades and positioning yourself accordingly while there's still time to make intelligent decisions. Let me start with a conversation that changed how I think about wealth preservation. A colleague of mine, someone who built a successful career and saved diligently for decades, called me recently and said something that stuck with me. He mentioned watching his retirement accounts fluctuate in ways he didn't fully understand, despite doing everything traditional financial planning told him to do. He diversified properly, invested in index funds, followed the standard playbook, and yet something felt different this time. The usual reassurances from advisors weren't adding up with what he was seeing in his actual account balances. That conversation made me realize how many people are experiencing the same quiet unease but aren't connecting the dots to the larger pattern unfolding around us. The reality is that we're watching the largest generation in American history move through a very specific phase of their financial lives, and this creates predictable pressures on asset markets that most people simply aren't prepared for. The baby boomer generation, roughly 73 million people, are hitting critical ages where federal tax law requires them to begin withdrawing from retirement accounts. These aren't optional withdrawals. After age 73, required minimum distributions force retirees to liquidate portions of their tax-deferred savings, whether they need the money or not. When you multiply those forced withdrawals across millions of people simultaneously, you create selling pressure in markets that has nothing to do with economic fundamentals and everything to do with demographics and tax law. Think about what happens when supply increases dramatically in any market. Prices adjust downward. This isn't controversial economics. It's basic supply and demand. When millions of people are required to sell stocks from their retirement accounts at roughly the same time. And when those same people begin downsizing homes and liquidating real estate holdings as they transition into different living situations, the combined effect creates sustained, downward pressure on asset prices. This doesn't happen overnight like a dramatic crash. Instead, it unfolds slowly and steadily over years, which is actually more dangerous because people don't recognize it as a structural shift. They interpret it as normal volatility and convince themselves to stay the course, even as their purchasing power gradually erodes. What makes this particularly challenging for people in their 30s, 40s, and 50s is that they're holding the exact same types of assets that are coming under this demographic pressure. Most people in this age range have concentrated wealth in three main categories: retirement accounts filled with stock market index funds, residential real estate, and perhaps some business ownership. These are precisely the asset classes that face headwinds as the baby boomer generation liquidates. You're essentially on the same side of a trade as 73 million other people who will be forced sellers over the next decade. When everyone is trying to exit the same positions simultaneously, finding buyers becomes difficult, and prices reflect that imbalance. The conventional wisdom that worked beautifully from the 1980s through the 2010s was built on favorable demographics. During those decades, the massive baby boomer generation was in their peak earning and saving years, pouring money into stocks and real estate. That created decades of rising prices because you had the largest generation in history on the buy side of those markets. But demographics are reversing now. The same generation that drove prices up as buyers is now on the sell side, and the generations behind them are smaller and have less accumulated wealth to absorb that selling. This demographic reversal is the single most important financial pattern to understand if you want to protect and grow wealth over the next decade. Let me be very specific about what this means in practical terms. Traditional diversification, the idea that you spread your money across stocks, bonds, and real estate to reduce risk, was designed for a different demographic environment. That strategy assumes that these asset classes move somewhat independently and that over time, markets trend upward because of growing populations and expanding economies. But when you face a prolonged period where demographics work against those assumptions, traditional diversification can actually increase your risk because you're diversified across multiple asset classes that all face the same demographic headwind simultaneously. It's like diversifying across different sections of the same sinking ship. The diversification doesn't protect you from the underlying structural problem. So what actually works in this environment? The answer is simpler than most people expect, but requires going against conventional financial advice, which is psychologically difficult. The most powerful position you can hold during a period of asset price deflation is liquidity. Cash and cash equivalents become extraordinarily valuable when prices are falling because your purchasing power increases even though the nominal amount stays constant. If you hold 40% of your wealth in cash and watch asset prices decline 30%, you haven't just preserved that cash, you've dramatically increased its real value. That cash can now purchase assets that previously cost significantly more. I understand this sounds counterintuitive because we've been conditioned to think of cash as a poor investment that gets eroded by inflation. But that mindset was formed during a 40-year period of rising asset prices and demographic tailwinds. In a deflationary asset environment, which is what demographic liquidation creates, cash becomes the highest performing asset because it doesn't decline while everything else does. More importantly, cash gives you optionality. When others are forced to sell assets at unfavorable prices because they're overextended or illiquid, you can step in as a buyer and acquire quality assets at substantial discounts. This is how generational wealth gets built during transitions like these. The second principle is understanding which assets benefit from an aging population rather than suffer from it. Not every sector faces headwinds from demographic aging. Some sectors experience tailwinds. Healthcare spending increases dramatically as populations age. The average person in their 70s spends multiples more on medical care than someone in their 30s or 40s. Companies that serve the healthcare needs of aging populations, from pharmaceuticals to medical devices to senior living facilities, see growing demand even as other sectors contract. Similarly, services that help people downsize and transition their lifestyles see increased demand. These aren't glamorous investments, but they're positioned correctly for the demographic reality we're facing. Conversely, you want to reduce exposure to sectors that depend on younger demographics for growth. Technology companies, for instance, derive much of their growth from younger consumers who adopt new devices and services rapidly. As wealth concentrates in older hands and the population ages, tech spending growth naturally slows. This doesn't mean these companies go to zero. It means their growth rates moderate and their valuations compress accordingly. Understanding these sector dynamics helps you position capital in areas that benefit from demographic trends rather than fight against them. Housing deserves special attention because it represents such a large portion of most people's net worth. The uncomfortable truth is that residential real estate faces significant challenges over the next decade as baby boomers downsize and the ratio of sellers to buyers becomes unfavorable. Many people in their 40s and 50s have 60% or more of their wealth tied up in their primary residence. They think of their home as their biggest asset and their retirement safety net. But an asset is only valuable if you can sell it at a favorable price when needed. If you're planning to sell your home in 10 or 15 years to fund retirement, and millions of other people are trying to do the same thing at the same time, the pricing environment becomes very unfavorable very quickly. This creates a painful choice that most people don't want to confront. If a significant portion of your net worth is concentrated in residential real estate, you're taking on substantial risk that this asset class underperforms or declines over the next decade. The rational response would be to reduce that concentration by selling and converting to more liquid assets, but that requires uprooting your life and making difficult lifestyle changes. Most people won't do it, which is why they'll experience significant wealth destruction when the asset they're most concentrated in declines in value. The people who do make that difficult choice and convert home equity into cash today will be positioned to buy real estate at much better prices 5 or 7 years from now when the selling pressure peaks. Let me address the psychological aspect of all this because understanding the pattern intellectually is one thing, but actually executing the right strategy is entirely different. Humans are wired to follow the crowd and trust conventional wisdom. Going against standard financial advice feels uncomfortable and even reckless. When you tell people you're holding 40% cash while the market is still near highs, they'll think you're crazy. When you suggest selling a primary residence to rent temporarily, people will tell you you're throwing money away. This social pressure to conform is intense, and it causes most people to stay in consensus positions even when the logic clearly points toward a different approach. The pattern I've observed repeatedly is that people rationalize their inaction by telling themselves they have time. If you're 40 years old, You might think you have 25 years until retirement, so short-term volatility doesn't matter. But this misunderstands the nature of compound returns. If you suffer a 30% loss early in your accumulation phase, you don't just need 30% gains to recover, you need 43% gains to get back to where you were. More importantly, that 30% loss comes off a larger base, so the absolute dollar amount lost is significant. A 25-year-old can recover from a major loss because they have decades of future earnings to rebuild. A 45-year-old who loses 30% of their accumulated wealth is in a fundamentally different position because they have fewer earning years ahead and less time for compounding to work its magic. This is why timing matters despite what conventional advice tells you about staying invested through all conditions. The stay invested always philosophy works when demographics are favorable and markets trend upward over time with temporary corrections. But during multi-year demographic transitions, that advice causes people to suffer unnecessary losses that they never fully recover from. The psychologically difficult but financially rational approach is to move to safety before the crowd recognizes the pattern, then deploy capital aggressively when panic sets in and assets are being sold at distressed prices. Let me also address business owners specifically because this demographic transition creates unique challenges for them. Roughly 12 million small businesses in America are owned by baby boomers who will attempt to sell those businesses over the next decade. The problem is that the generation positioned to buy those businesses, Generation X, is significantly smaller and has less accumulated capital. When you have millions of business owners trying to sell to a much smaller pool of potential buyers, valuations compress dramatically. Business owners who are counting on selling their company for 3 or 4 times earnings to fund their retirement may find that multiples have compressed to 1.5 or 2 times earnings by the time they're ready to sell. That's a 50% or more reduction in expected exit value, which completely changes retirement plans. If you own a business and you're counting on its sale value for financial security, you need to either sell much earlier than planned while valuations are still reasonable, or you need to have backup plans that don't depend on achieving historical valuation multiples. Waiting and hoping that your business will command premium valuations in 5 or 7 years is a high-risk strategy when millions of other business owners will be competing for the same small pool of buyers. The overarching theme here is that the financial strategies that worked brilliantly for the past 40 years are based on demographic conditions that no longer exist. The baby boom generation created 40 years of tailwinds as they accumulated wealth and drove asset prices higher. That same generation is now creating headwinds as they liquidate wealth and drive asset prices lower. This isn't a temporary phenomenon that will resolve in a year or two. This is a decade-long structural shift that will reshape which assets perform well and which assets destroy wealth. The people who will thrive during this transition are those who recognize the pattern early, have the courage to position themselves against conventional wisdom, and maintain the discipline to hold liquidity until genuine opportunities emerge. This requires thinking independently, acting decisively, and being willing to look foolish in the eyes of people who don't understand what's happening. But 5 or 10 years from now, when asset prices have reset and you've been able to deploy capital at the bottom, the financial rewards for positioning correctly will be extraordinary. I'm not suggesting this is easy or comfortable. Going against consensus is psychologically difficult. Holding cash while others are invested feels like you're missing out. Selling a home you love to rent temporarily feels like a sacrifice. But these temporary discomforts are minor compared to the long-term consequences of being positioned incorrectly during a major demographic transition. The choice is between being comfortable now and struggling later, or being uncomfortable now and thriving later. Most people choose comfort in the moment and pay the price over time. If you're watching this and you're between 35 and 65, I want you to do something specific right now. Calculate what percentage of your net worth is liquid versus tied up in illiquid assets like real estate and retirement accounts. If that liquidity percentage is below 40%, you have concentration risk that could cause significant wealth destruction over the next several years. Then look at what sectors and asset classes you're exposed to, and ask honestly whether those sectors benefit from or suffer from an aging population and demographic liquidation. If you're concentrated in areas that face headwinds, you need to make decisions about whether you're willing to reposition or whether you're comfortable accepting the likely outcomes. This isn't about perfect timing or trying to call exact market tops and bottoms. This is about recognizing a multi-year trend and positioning yourself on the right side of it with enough time to benefit. The window for making these decisions is narrowing because asset prices have already begun adjusting and the demographic wave is already in motion. The people who act in the next few months will be vastly better positioned than those who wait another year or two. I also want to be clear that this isn't a prediction of economic collapse or societal breakdown. This is simply demographic math playing out in predictable ways. Societies and economies continue functioning during these transitions, but wealth gets redistributed from those who are positioned poorly to those who are positioned well. Your goal should be making sure you're on the receiving end of that redistribution rather than the losing end. If this analysis resonated with you and made you think differently about how to position your finances, I'd appreciate it if you'd take a moment to like this video and leave a comment sharing your thoughts or questions. And if you want to see more content that challenges conventional financial wisdom and helps you think independently about money, make sure you're subscribed to this channel because I'll continue exploring these patterns and sharing insights that most people won't discuss openly. The most valuable financial education comes from understanding structural forces rather than following short-term market noise, and that's what we focus on here. Thanks for watching, and I'll see you in the next one.